So look, so far what we've covered is factual, but I have two questions here that are more of opinions while still relating to mutual funds and then these scheme-related documents and fundamental characteristics. The first one, please, whoever is more opinionated can take. Why on earth do we have these dividend plans in the first place? They don't even seem to be called dividend plans. I don't even know what they're called anymore. But why do they exist? Dividends are so tax inefficient for pretty much everyone, right? Shouldn't we just do away with these? And sometimes they cause confusion because a person thinks that they have a growth plan, but they don't. And that is fairly unfortunate. Where would you go with this?
Well, dividends didn't used to be taxed like it is today. So I think there's a relic from that point. And but it has a lot of history. I think Deepak will know all the history of dividend plans, dividend reinvestment plans. And there were plans where they would be selling hybrid schemes to retirees, saying "Ki this is a fixed income you'll get every month." But it was effectively a mix of dividend and some of their capital being given back to them. So I think all of those have been fixed so far.
Okay. So
Yeah, no. The history is intense because I think it was 2005 when dividends went off the taxation bandwagon, and or 2006, I don't remember when that was. But since then, mutual funds then decided to call their payouts as dividends. But it's not necessarily dividend. For instance, if a equity fund invests in 100 stocks and all those 100 stocks pay you 1% dividend, that means technically you have 1% available to distribute as dividend, and then you should be able to distribute them. But guess what? The 100 stocks also went up in price by another 10%. So now you have 1% dividend, but also 10% increment. So I have 11% that's available to distribute. So I maybe do a 2% dividend. So this is not just dividend. So they call it an investment distribution and capital withdrawal. So 1% is the capital that has grown and that you're withdrawing from. So it's called IDCW, which I don't even know what that means. But the problem with that is that after 2019, I think, is when they started getting taxed. So since they were not really dividends, and then dividends of companies also started getting taxed, dividends paid out by mutual funds are also taxed. And this is a problem because now it's mostly your capital growing. And if you take the money out, if the mutual fund pays you out something, you're going to get taxed on that dividend in full as income. Now, like, I didn't do anything. I just invested in something for the long term. They paid out some money to me, which I didn't want in the first place. And I'm paying dividend on that. I mean, tax on that. That sounds unnecessary. So the growth option just takes the money that's with the the mutual fund receives as dividends and reinvests it automatically. So that's a growth plan. Now, some of these when dividends were not taxed, it was actually tax efficient to do a dividend reinvestment. Get the dividend, have that dividend buy new units. So essentially, you are booking out profits from the fund without any taxes and then reinvesting it back. But if there was
You are increasing your cost of acquisition.
your cost of
So your
acquisition.
ultimate capital gain may be lowered because you're averaging your cost.
Yes,
Okay,
but at
okay.
that time, capital gain was not taxed.
Yeah.
So it was very strange of why you would choose to have a dividend reinvestment plan in the first place. Because there was a time in which capital gains was taxed and dividends were not taxed. So therefore, you had an dividend reinvestment. And even today, there are relics of that time. For instance, most ETFs, you don't have a growth plan. An ETF can choose to distribute dividend anytime it wants. And because EPFO used to own one of the largest, they own even now more than 90% of one of the largest Nifty 50 ETFs in the country, they essentially forced the Nifty 50 ETF to pay out dividends. So other people owning this Nifty 50 ETF for no fault of their own suddenly started getting dividends on which they were taxed, right? So this is, as I'm talking about, 1 or 2 years ago. And then it took some time for.
I think it was in the middle of the pandemic, so everyone's a bit taken
aback
surprised
by
by
this.
this.
Yes.
But anyway.
And eventually, the EPFO people had to be trained to say you could sell these units
Instead of us.
Yes, you could redeem them back with the mutual fund house, and they would pay you back those units in terms of stocks, and then you could redeem them, and that was a much better way to book your profits than to try to actually force the fund to give a dividend to everyone else. So that was one layer of this. The other one is there's a liquid ETF. The liquid ETF is typically what is used by people who are trading in the market to say, I have some excess cash remaining in my brokerage account. Instead of it not yielding any money, let me buy something that's a liquid ETF. And most of the original liquid ETFs that came about in the country had a daily dividend reinvestment process. I mean, daily they would pay dividend so that the NAV would remain at 1,000. So 1,000 rupee NAV was what you paid was 1,000 rupees. And then if it earned some money overnight for it, it would earn maybe 5 paisa. That 5 paisa was then taken out and then reinvested in new units because you could do fractionals as well. And you would automatically get new units, but the NAV would stay at 1,000. Even today, such ETFs are available. Unfortunately, because it's so tax inefficient, your NAV may be 1,000. At the end of the year, somebody is going to send you a statement saying, listen, you had so much dividend because you had maybe 10 lakhs or 10, 15 lakhs sitting in this ETF. It's paid out maybe 50,000 rupees. And on that 50,000 rupees, you have to pay full taxes, of which we have deducted 5,000 rupees as taxes at source, TDS at source. So it doesn't help you at all because this TDS, first of all, whatever dividend you receive, the TDS is 10% of that. So only 90% of the money is available to reinvest. And then on top of that, you have to pay tax on that overall money that you receive as dividend as well, because your tax rate may be higher than 10%. So this dividend reinvestment is a relic of the past, still remains in certain ETFs. Some funds, you cannot choose the growth option because they are ETFs with only a regular option. Only a dividend-ish kind of option.
Or there is no option.
There is no
Just
option.
buy it
Yeah,
and they do what they want.
They do what they want. So yeah. So I mean, I think that's where this thing is. I'm not a fan. I think right now growth should be the only possibility
Well, we don't have a dividend option in our scheme.
in us. Yeah.
But
We only have
sir,
growth.
I actually, again, I know I'm coming with my bias, but look, if first I'll just remind you, a book that both of you recommended to me, which I did finally read, was the one by Ed Sharp. I can't remember the name, but where he was where he talked about how the universe, everyone seems to prefer getting a monthly income rather than having a capital base which they have to withdraw from, and that was fairly interesting. And I see that here. But the fact is that if you invest in a mutual fund, the mutual fund buys a stock. That stock spits out an enormous dividend. The mutual fund is able to accrue that dividend tax-free, reinvest it for you, and grow tax-free. Had you owned that stock directly, you would be disadvantaged because the moment that thing showed up, you'd have be at, I don't know, 36% tax on it or not. So it really feels like you're giving up the benefit of a mutual fund today by having it pay you back some dividend. But I concede, as you've both pointed out, that taxes are always changing, and so products cannot
Even if
exist.
it's changing, I think the growth option is still the most
Probably the better.
simplest one to stick with, because whenever you need cash, you can just sell and get it. And now you have all these options, right? SWPs, you can do systematic withdrawal plans. You can just put it in a growth plan and then do an SWP. Every month you can get the money back. And it'll be capital gains. It won't be income.
Yeah, I mean, in fact, mutual fund is, since it's the most tax efficient vehicle for even getting dividends. Sometimes there are these opportunities in the stock market where a stock is giving a ridiculously high amount of dividend. Now, unfortunately for me, let us say I own that stock for 10 years. And the stock price is 1,000 rupees. And suddenly this company wants to pay 800 rupees because it has sold most of its business to somebody else. It wants to pay 800 rupees as dividend. I hate it because at 1,000 rupees, if I sold it, I would pay 12.5% long-term capital gains tax. But if it pays me 800 rupees as dividend, I am automatically taxed to that 800 rupees at the highest possible rate. So at which time I am saying, listen, I would rather sell this. Now, if there were only people like me, nobody would want to buy this stock because they would be like, listen, I'm not buying it at 1,000 rupees to receive 800 back of my own capital.
Taxed at
Taxed at 36% or 40% or 35%, 36%. So this is where a mutual fund can step in and say, listen, you want to sell, I'll buy. I don't have any taxes on the incoming dividends. So I would therefore be the buyer for that stock. In fact, because of in one such situation that actually occurred, the stock was selling for less than the dividend was going to pay out. Because the individuals receiving this were like, we don't want it because I'm not going to pay 800 rupees to pay. Yeah. So they were dumping it. And at that particular time, it wasn't apparent to me why, but no mutual fund was jumping in trying to buy this stock. And it was really surprising to me because I was like, it's almost like free money. I mean, if I paid 800 rupees per stock to get 850 rupees worth of dividend, this sounds like it's a free 4% or 5% gain for a mutual fund. But sometimes these are not, maybe they're at that particular time it wasn't obvious to the mutual fund universe, but now I'm sure it is, and lots of interesting things happen from that perspective. So I think this concept of dividend has evolved in a very, very strange manner.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully. Past performance may or may not be sustained in future and is not a guarantee of any future returns.